What is an investment trust and should you be investing in them? How do they differ from other investment funds?
In this video, we're going to explain in simple terms exactly what an investment trust is, why we like them, and why you should be adding some to your portfolios. Let's check it out.
Welcome to Money Unshackled, the investment channel that sets you and your finances free. I'm Andy, this is Ben, and if you like what we say, hit the like button and click subscribe. Also, if you want to support the channel, check out some of the affiliate links that we put in the description below. We put a list of cool stuff in there that will help you become financially free. Let's get into it.
What is an investment trust? An investment trust is a form of collective investment, but they are very different from unit trusts and OICs. These are open-ended, whereas an investment trust is closed-ended. We'll come back to this shortly.
Don't get confused by the name, as they are in fact not trusts in the legal sense. They are in fact companies that are listed on a stock exchange, similar to that of other publicly traded companies.
They have a lot of history, with the first one being opened in 1868. This was the Foreign and Colonial Investment Trust, and impressively is still going today.
We often preach about passive index tracking funds, but investment trusts are actively managed. A fund manager is usually responsible for managing the assets of the investment trust, and will usually invest in stocks and shares according to the investment objectives of the fund.
For instance, some specialise in investing in small companies, which is an area that we're particularly interested in at the moment, because small companies offer larger returns in the long term and is something that is currently neglected by index funds.
So what is an open-ended and closed-ended fund? When an investor gives their money to an open fund, the fund increases in size and the investor receives units or shares for their investment. If the investor then chooses to sell their units or shares, then these are cancelled and the fund will then shrink in size.
A closed-ended fund, however, has a fixed number of shares issued which are then traded on the stock exchange. It's important to note that a closed-ended fund is different to a closed fund, which means that the fund is closed to new money.
If you're unfamiliar with the different fund types, then it might not sound like it matters, but it is absolutely essential that you understand this so that you make the right investment decision for you. Each fund type has its pros and cons.
What we like about investment trusts. Number 1. No liquidity issues. Better returns? Investors act irrationally and tend to sell when markets are in trouble, crystallising their losses. An open-ended fund will then be forced to sell that person's investment at the worst possible time. This means that you will be punished for other people's bad decisions. Also, because of this, funds tend to hold on to extra cash for liquidity for such a scenario, which means that you could end up getting a worse return.
Investment trusts, which are closed funds, do not have this problem, as when an investor sells, they actually sell to another investor. This means that investment trusts don't need to hold back extra cash for panicky investors. The share price of the investment trust goes up and down according to the investor supply and demand, therefore allows the fund manager to concentrate on investment performance and not on liquidity issues.
Number 2. Usually trade at a discount. An investment trust usually trades at a discount to its net asset value. Some even trade at a premium, but this does not mean that they are a bad investment.
This creates additional risk when compared to other investment fund types, but a narrowing of the discount can lead to a greater boost to returns. Also, we see a discount as an opportunity to buy a collection of investments below their market rate.
Number 3. Gearing. Unlike other funds, an investment trust can actually borrow money to help fund its investments. You can actually check its gearing levels and allow debt before you invest.
If you've seen any of our videos before, then you'll know that gearing or leverage can be used to increase investment returns, albeit at a higher risk.
Number 4. Dividend payouts. Many investment trusts are dividend superstars, many having increased their dividend over the last 50 consecutive years, which is remarkable.
They are able to do this because, unlike open-ended funds, they don't have to distribute all of the income generated by their assets to the investors each year. They are able to hold back 15% each year, which allows them to build up a reserve for when times get tough.
Based on all this, many investment trusts will outperform alternative investments, which is why we think that you should consider investing in them as part of your diversified portfolio.
Question of the day: will you be investing in an investment trust, and if so, which one? Let us know in the comments section. Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is Money Unshackled. See you next time.